welcome to our weekly look ahead at the markets. And where we've been in the last week, it's been a bit of a chop sideways for indices, a bit lower in Europe and the US, but kind of choppy trading. The US finally reversed its longest losing streak since October on Thursday. We saw some clawing back just as those jobless claims numbers indicated that there's a slowing in the economy. Higher jobless claims, both initial and continuing claims, was that bad news is good news for the stock market on Thursday. And really the market is paying close attention to what's coming up this week. It's been in a sort of wait and see mode because this week is this massive central bank week with the Fed, the European Central Bank and the Bank of England all in action, the Swiss National Bank as well. We also have the US CPI number out. Now remember that will be the final piece of data before the Fed meeting, the Fed decision on Wednesday. The Fed kicks off its two-day meeting on Tuesday, and on Tuesday we get this very important CPI number. And in the previous month it declined to 7.7%, its slowest in some time, and well below the 8% expected. So that slowdown in October, that carries through. We see further slowing into November, then you'll see the market probably rally. It will think that, well, we're past the peak inflation. The Fed is on course to slow down rate hikes. We think it's going to go for 50 basis points on Wednesday. That would be the first of that size move for some time. It's been going 75 basis points per meeting for the last few meetings. And so this is the slowdown. It's not a pivot, but it is a pause, or at least it's a slowing down. And so really the question mark will be, what does the Fed think it's going to do into next year, and what does the market believe the Fed needs to do? So the inflation number is all important on that front. As I said, Wednesday we've got the Fed and 50 basis points. The market seems to be thinking if the inflation numbers are actually a bit hotter, maybe you see expectations for 75 basis points coming. I have to reiterate what Governor Waller said. Quit paying attention to the pace and the timing. It's the destination that matters. It's where the Fed ultimately gets to. It's where that terminal rate is. And I think that needs to keep on moving higher, because I don't think the Fed can really get a grip on this inflationary dynamic that we have. Wages were hot from the non-farm payrolls. I think we are seeing wages being strong, although not maybe keeping up with inflation, but still driving inflation because they keep on rising. And then into next year, we think that this plays out with you get recession plus inflation. This is the stagflation nightmare, and that could be bad for both bonds and stocks. So on to Thursday, and European Central Bank also expected at 50 basis points. They've been sounding like they're nearing the end of their tightening cycle. They're getting jittery feet already. I think this raises a question mark about whether or not they can actually carry out any QT next year, but we'll see. And then the Bank of England also in action, again at 50 basis point hike, but again they're going to signal that the market's too far ahead. We're not going to hike rates that much more. They're worried about a property crash in the UK, and that would have serious consequences for GDP, and that is probably front and centre of their thinking right now. Coming into the year end, once these central banks are out of the way, you've got the potential for that Santa rally towards the end of the year after Christmas. So we'll keep an eye out on that one. We've got an article up on the website talking about the Santa rally, so do check that one out. And then into next year, of course, we've just recently released the watch list, and that has all the sort of thinking about themes, big macro themes for next year. So do check that one out as well. Thanks for watching.